Namaskar and greetings to all in this month of Raksha Bandhan, Independence Day, Janmashtami, Parsi New Year, and Ganesh Chaturthi. May this pious and auspicious month bring good luck to all of us and to our economy. The monsoon season has been progressing well. We are also approaching the festival season, which typically brings greater enthusiasm and buoyancy in the economic activity. This favorable setting, together with supportive policies of the government and the Reserve Bank, augurs well for the Indian economy in the near term, as geopolitical uncertainties have somewhat abated, even though global trade challenges continue to linger. Over the medium term also, the Indian economy holds bright prospects in the changing world order, drawing on its inherent strength, robust fundamentals, and comfortable buffers. Opportunities are there for the taking, and we are all making efforts to create enabling conditions through a multi-pronged yet cohesive approach to policy making. Globally, policymakers are faced with muted growth and slowing pace of inflation, with some advanced economies even witnessing an uptick in inflation. As the dust settles and a new equilibrium emerges in the new global order, policymakers will have a tough task navigating a world characterized by modest growth, sticky inflation, and elevated public debt levels. At the Reserve Bank, leveraging on the room provided by a significant moderation in inflation, we have taken decisive and forward-looking measures to support growth. The coordinated use of various tools available to us has helped accelerate monetary policy transmission in the current easing cycle. The Monetary Policy Committee, MPC, met on the 4th, 5th, and 6th of August to deliberate and decide on the policy repo rate. After a detailed assessment of the evolving macroeconomic and financial developments and the outlook, the MPC voted unanimously to keep the policy repo rate under the Liquidity Adjustment Facility (LAF) unchanged at 5.5%. Consequently, the standing deposit facility rate shall remain unchanged at 5.25%, and the marginal standing facility rate and the bank rate at 5.75%. The MPC also decided to continue with the neutral stance. The MPC noted that while headline inflation is much lower than projected earlier, it is mainly due to volatile food prices, especially in vegetables. Core inflation, on the other hand, has remained steady around the 4% mark as anticipated. Inflation is projected to go up from the last quarter of this financial year. Growth is robust and as per earlier projections, though of course below our aspirations. The uncertainties of tariffs are still evolving. Monetary policy transmission is continuing. The impact of the 100 basis points rate cut since February 2025 on the broader economy is still unfolding. On balance, therefore, the current macroeconomic conditions, outlook, and the uncertainties call for continuation of the policy repo rate of 5.5% and wait for further transmission of the front-loaded rate cut to the credit markets and to the broader economy. Accordingly, the MPC unanimously voted to keep the repo rate unchanged. The MPC further resolved to maintain a close vigil on the incoming data and the evolving domestic growth inflation dynamics to chart out the appropriate monetary policy path. Accordingly, all members decided to continue with the neutral stance. Now I'll turn to an assessment of the growth and inflation in our country. First of all, growth. Domestic growth is holding up and is broadly evolving along the lines of our assessment, even though some high frequency indicators showed mixed signals in May, June this year. Rural consumption remains resilient, while urban consumption revival, especially discretionary spending, is tepid. Fixed investment, supported by buoyant government capex, continues to support economic activity. On the supply side, steady southwest monsoon is supporting kharif sowing, replenishing reservoir levels, and boosting agriculture activity. Moreover, services activity remains steady, though some high-frequency indicators recorded a modest expansion. Services PMI increased to an 11-month high of 60.5 in July 2025. Construction activity continues to exhibit resilience. However, growth in the industrial sector remained subdued and uneven across segments, pulled down by electricity and mining. While the manufacturing PMI remained elevated in Q1, the IIP, Index of Industrial Production, showed moderation. Turning now to the growth outlook, the above normal southwest monsoon, lower inflation, rising capacity utilization, and congenial financial conditions continue to support domestic activity. The supportive monetary, regulatory, and fiscal policies, including robust government capital expenditure, should also boost demand. With sustained growth in construction and trade segments, the services sector is expected to remain buoyant in the coming months. Prospects of external demand, however, remain uncertain amidst ongoing tariff announcements and trade negotiations. The headwinds emanating from prolonged geopolitical tensions, though abated as I mentioned earlier, persisting global uncertainties, and volatility in global financial markets pose risks to the growth outlook. Taking all these factors into account, real GDP growth for 2025-26, the current year, is projected at 6.5%, our earlier projection, with Q1 at 6.5%, Q2 at 6.7%, Q3 at 6.6%, and Q4 at 6.3%. Real GDP growth for Q1 next year, 2026-27, is projected at 6.6%. The risks are evenly balanced. I will now speak on the domestic inflation. CPI headline inflation declined for the 8th consecutive month to a 77-month low of 2.1% in June. This was driven primarily by a sharp decline in food inflation, led by improved agricultural activity and various supply-side measures. Food inflation recorded its first negative print since February 2019. It was negative 0.2% in June. Double-digit deflation in vegetables and pulses drove this contraction. High-frequency price indicators signal a continuation of the lower price momentum in fruit prices to July, the last month as well. Fuel group inflation moderated over 2 successive months to record 2.6% in June. Core inflation, on the other hand, which remained within a narrow range of 4.1 to 4.2% during February to May this year, increased slightly to 4.4% in June, partly driven by continued increase in gold prices. The inflation outlook for 2025-26 has become more benign than expected in June. large favorable base effects combined with steady progress of the southwest monsoon, healthy kharif sowing, adequate reservoir levels, and comfortable buffer stocks of food grains have contributed to this moderation. CPI inflation, however, is likely to edge up above 4% in Q4 of this year and beyond, as unfavorable base effects and demand side factors from policy actions that we took a little while ago, a few months ago, come into play. Barring any major negative shock to input prices, core inflation is likely to remain moderately above 4% during the year. Weather-related shocks pose risks to inflation outlook. Considering all these factors, CPI inflation for the current year 2025-26 is now projected at 3.1%. This is down from 3.7% that we had earlier projected in June, with Q2 at 2.1%, Q3 at 3.1%, and Q4 at 4.4%. CPI inflation for Q1 next year, 2026-27, is projected at 4.9%. The risks are evenly balanced. I will now be speaking about the external sector. India's current account deficit CAD moderated to 0.6% of GDP last year in 2024-25 from 0.7% of GDP in 2023-24. And I want to underline over here that it is not only in percentage terms as a proportion of GDP that it decreased by about 0.1% because of the expansion in GDP, but also because of a decrease in absolute terms of CAD by about $3 billion US dollars from $26 billion to $23 billion. And this is on account of robust services exports and strong remittances receipts. Despite a higher merchandise trade deficit, we have been recording, as you are aware, a high growth rate of about 17% in services exports in the last 4 years, and about 14% compounded annual growth rate of remittance receipts in the last 4 years ending 2024-25. This has made up more than for the higher merchandise trade deficit that we had last year. The merchandise trade deficit further widened in Q1 of 25-26. India's share in world services exports has risen markedly from about 2% in 2005 to 4.3% in 2024, driven by strong software and business services exports. Robust services exports coupled with strong remittance receipts are expected to keep the CAD within sustainable level even during the current financial year. On the external financing side, gross FDI to India remained strong during April to May 2025-26 this year. However, net FDI moderated during this period due to higher outward FDI. FPI inflows to emerging markets and economies have remained strong in May and June 2025. However, net FPI to India recorded outflows of 0.8 billion US dollars this year so far till July 31. This is mostly on account of outflows in the debt segment. External commercial borrowings, on the other hand, witnessed higher net inflows compared to that last year. Inflows under non-resident deposits too remained positive, albeit witnessing some moderation. As on 1st August 2025, India's foreign exchange reserves stood at a robust $688.9 US billion, sufficient to cover more than 11 months of our merchandise imports. Overall, India's external sector continues to remain resilient. We remain confident of meeting our external financial requirements comfortably. I will now turn to liquidity and financial market conditions. System liquidity as measured by the net position under the liquidity adjustment facility has been in surplus on an average of about 3 lakh crore rupees per day since the last MPC. This is in comparison to an average daily surplus of 1.6 lakh crore rupees during the previous 2 months. Going ahead, as the CRR cut announced in last policy comes into effect in a staggered manner beginning September, it would further support liquidity conditions. The comfortable liquidity in the banking system has reinforced transmission of the policy repo rate cuts to the money, bond, and credit markets during the current easing cycle. In the credit market, the weighted average lending rate of scheduled commercial banks declined by 71 basis points as against the 100 basis points rate cuts for fresh rupee loans, and of this 55 basis points is due to interest rate reduction, the remaining on account of the change in the mix of the loans. Further, on outstanding rupee loans since February 2025 to June 2025, there has been a 39 basis points reduction in the weighted average lending rate. On the deposit side, similarly, the weighted average domestic term deposit rate on fresh deposits moderated by 87 basis points during the same period. Moreover, the transmission to lending rates has been broad-based across all sectors. Going ahead, the Reserve Bank will continue to be nimble and flexible in its liquidity management. We will endeavor to maintain a sufficient liquidity in the banking system so that the productive requirements of the economy are met and transmission to money markets and the credit markets remains smooth. Here I would like to take a moment and mention, while we are on this subject of liquidity, that an internal working group, as some of you may be aware, had been set up by the Reserve Bank to review our extant liquidity management framework, which has been in operation since February 2020. It had been 5 years. So this working group was set up. It has submitted its report, and we will be shortly publishing the same on our RBI website for public consultation. The group broadly has found that the Walker, the weighted average call rate, is highly correlated with the other money market rates, with TREPS and market repo in the collateralized segments. Further, they have also found that it is effective in transmitting signals to other money market instruments across maturities. Therefore, the group has recommended continuation of the overnight Walker as the operating target of monetary policy. The group has inter alia also recommended to continue with the variable repo and reverse repo rate auction mechanisms of various tenors with the objective of maintaining the operating target rate at the policy rate. I will now come to financial stability. The system level financial parameters relating to capital adequacy, liquidity, asset quality, and profitability of the scheduled commercial banks continue to remain very healthy. The CRAR is more than 17%, NIM at 3.5%, the liquidity at 132%, GNPA at about 2.2%, NNPA at about 0.5 to 0.6%. The credit deposit ratio for the banking system is at 78.9%, broadly similar to that a year ago. Similarly, the system level parameters of NBFCs too are sound with adequate capital position and improved gross NPA ratios. Bank credit grew at 12.1% last year in 2024-25. And I want to highlight over here that while it was slower than the growth rate of 16.3% in 23-24, it is higher than the average growth rate of 10.3% recorded in the 10-year period preceding 24-25. Moreover, it is important to look at all sources of funding to the non-financial sector and not only bank credit. And so we find that in 24-25, while the bank credit, non-food bank credit in fact, reduced by about 3.4 lakh crore rupees from 21.4 lakh crore to almost 18 lakh crore, the flow from non-bank sources more than made up for this decrease. Thus, even though growth rate of bank credit slowed last year, the overall flow of financial resources to the economy increased from 33.9 lakh crore rupees in 23-24 to 34.8 lakh crore rupees last year. That is an increase of almost a lakh crore of rupees. And we find that this trend continues even during the current financial year. As transmission to money markets has been faster, large corporates increasingly have relied on market-based instruments such as commercial paper and corporate bonds to source funds, reducing their exclusive reliance on bank credit. Similarly, profitability of large corporates has increased. Their internal resources, therefore, have become an important source for business expansion. Before I conclude, let me underline that for us at RBI, the interest and welfare of citizens of India is foremost. It is the people of India, including those at the very bottom of the pyramid, who are our raison d'etre, the reason of our being. In this regard, therefore, I have three consumer-centric announcements to make. One, as Jan Dhan scheme launched about 10 years ago, completes now the decade. A large number of accounts have therefore become due for re-KYC. The banks are therefore organizing camps at Panchayat level from 1st of July to 30th of September in an endeavor to provide services at consumer doorsteps. Apart from opening new bank accounts and re-KYC, the camps will also focus on micro-insurance and pension schemes for financial inclusion and customer grievance redress. Two, we will be standardizing the procedure for settlement of claims in respect of bank accounts and articles kept in safe custody, or in other words, safe deposit lockers of deceased bank customers. This is expected to make settlement of such claims more convenient and simpler. Three, we are expanding the functionality in RBI Retail Direct platform to enable retail investors to invest in treasury bills through systematic investment plans. I now make my concluding remarks. Despite a challenging external environment, the Indian economy is navigating a steady growth path with price stability. Monetary policy has appropriately used the policy space created by the benign inflation outlook to support growth without compromising on the primary objective of price stability. Transmission of our recent policy actions to the broader economy is underway. As the Indian economy strives to attain its rightful place in the global economy, a stronger policy framework across domains and not just limited to monetary policy will be pivotal in its journey. We, on our part, will continue to be agile and proactive in maintaining and providing a facilitative monetary policy, which will be based on incoming data and the evolution of the growth inflation dynamics. As always, we will have a clear, consistent, and credible communication backed by actions necessary for the task at hand. Thank you, Namaskar, and Jai Hind.
Okay, you're watching the live stream here, Moneycontrol live stream, and we are coming to you live on the RBI policy outcome. Of course, as we saw, the governor has announced, the rate cut decision. No change in rates, repo rate at 5.5%, and the stance has also been kept neutral. Unanimous decision, and all right, welcome to this special coverage on the RBI policy. Of course, we heard the governor. He has kept rates unchanged. The street was fairly divided. One section was expecting a 25 basis point rate cut, given the fact there could be some bit of slowdown in the wake of higher tariff uh, from the US, but that hasn't really happened. Of course, we'll see whether or not the governor really doles out a rate cut in the October policy or not, because we have the Fed policy ahead of that in September. So let's see how things really pan out. But in terms of inflation forecast, it has been cut to 3.1% from 3.7%. Street was expecting somewhere around 3% or 2.9% as well. But 3.1%, that's the inflation forecast for FY26. But the governor has said that there could be an increase in inflation from the fourth quarter of FY26, which is why he's kept the Q4 FY26 estimate unchanged at 4.4%. But for both the second and third quarters, the inflation forecast has been slashed, given the fact that, of course, we have inflation at a 6.5-year low. And for the first quarter, it is lower than what the RBI had forecasted in the last policy. It's at 2.7% vis-a-vis the forecast of 2.9%. For GDP, however, the governor has kept his forecast for the real GDP forecast for FY26 unchanged at 6.5%. For the first quarter of FY27, it's at 6.6%. So yes, an inflation forecast cut has come by, but GDP forecast has been kept unchanged. So, how do you really read into this statement? Do you expect a cut in September, in October, I beg your pardon, or would you expect a cut in December? Or has the governor signaled that he's already front loaded the rate cuts, so perhaps there could be no rate cuts at all? But let's get on board our experts then. Let me first bring on board our banking editor at Moneycontrol, Hamsini Karthik. Hamsini, great to have you here. We heard from the governor, uh, you know, rates unchanged, which was something that we were also expecting, right? And inflation forecast cut, but GDP forecast has been kept unchanged. And that despite the fact that we are staring at higher tariffs, you never know what will happen on that front, given the fact that we have a very stark warning coming from Trump that there could be higher tariffs because of the oil trade with Russia. GDP forecast unchanged. Has the governor signaled that there could be no rate cut,
Yeah.
or if at all, one more rate cut going forward? How are you reading into the statement?
I think it's pretty much on expected lines because just saw the stance change from accommodative back to neutral in the last MPC, and this time around the stance has been maintained at neutral. What this means is that the governor is possibly, or rather the MPC is possibly looking at how all the transmission happens before taking any further action on the rate, and that seems to be happening, on expected lines. Fresh rupee loans are down by about 55 basis points purely on interest rate reduction against a 100 basis point repo reduction, which means that banks are transmitting whatever rate cuts that we've seen up until now quite healthily to customers. Interesting enough is to note that even on term deposits, there has been an 87 basis point reduction in the cost of, or rather, in the deposit rates earned by fresh money that people put into banks right now. which means that banks are front ending or front loading the rate cuts on deposits. They're just playing it out right now on the fresh loans. There is still more room to cut rates on fresh loans. We will see how that percolates to growth, and then possibly take the next action as far as rates is concerned. This the whole to me also suggests that we are not really affected by what the US does in terms of tariff. Domestically, our situation is strong. We will not cede into or we will not play or reveal ourselves as victims or being affected really because of the tariff scenario between India and US. It's a strong statement to make. We remain quite undeterred by the external factors right now. It's a very strong statement to
Hmm.
make,
All
though
right, a very
made a
strong
little
state.
indirectly, but still a good point revealed by the governor.
Sure. So Hamsini, we have the press conference at 12 p.m. Right? Any tough questions that you'll be posing to the governor?
The other interesting point to me, which I noted in his speech, was the fact that discretionary spendings are not on expected lines, and this is a very important thing to watch, because this is going to have a cascading effect on growth ultimately. And when we speak to bankers, I mean, I've been speaking to bankers for most of last week to July to now. The commentary that we got from banks also is somewhat suggestive that where is growth going to come from? Because even if bankers are willing to lend, the situation right now seems as though borrowers are not willing to take on too much leverage, and that's not a very comfortable situation to be in as far as growth is concerned, right? And we also saw how the governor quickly defended the year-on-year decline in growth rate by taking a 10-year statistic to demonstrate that when you look at the 10-year average, which pans out to around 10 odd percent, 10.3% or ballpark thereof, we're still very comfortable at a 12% growth that we saw as per the last data prints. So that is an interesting defense he's making to justify that there is good enough growth signs, but bankers are saying a completely different narrative. So that would possibly be the point that I would quiz the governor on, maybe within an hour or so from now. Yeah.
Hmm. Okay, so till now, the 100 basis point rate cut that the governor has doled out in FY25 hasn't really percolated down to NBFCs, right? So EBLR linking to NBFCs, could that be a possibility sometime soon? Would you be asking the governor the same, Hamsini?
That's right, but we should also remember that although the word finance minister said is no longer applicable for NBFCs as shadow banks, it's all NBFCs are also possibly somewhere a little a step down in the value chain as far as rate transmissions are concerned. So for them, it might be another 1-2 quarters kind of situation, although on a real time basis they are beginning to see some sort of a cost benefit. To say that NBFCs, for NBFCs the cost of funds is really not yet cooled off, maybe an
Hmm.
entire maybe not entirely true. It's sort of partly correct and partly incorrect. We'll have to wait it out. But having said that, Nandita, we also need to appreciate that a lot of NBFCs deal with MFIs as well, directly or on a non-lending basis. That is a segment where banks continue to remain a little, watchful of. Some of the banks have direct exposure to MFIs. Some of them are doing it through NBFCs, etc. So, how is the MFI crisis going to really pan out? How are the unsecured loans as a basket? We saw the
Hmm.
recent print from CRIF data showing that in unsecured loans, NPAs are still a little high. We are still seeing at gross level between 4 and 6%. One needs to see that cool off a little more in the unsecured PL basket before banks can become a little more aggressive or lose the fear that they had on NBFC lending a couple of years back. So yes, it might be a little more gradual for an NBFC borrower to really draw benefit from a rate cut, because
mm,
there is no hard and fast rule as such for them to adopt a EBLR mechanism, much as what banks do. It's more out of
mm,
a business model perspective that most NBFCs currently are adopting EBLR, not from a mandatory perspective. So we'll have to wait
mm,
out if you borrowed from let's say a Bajaj housing or a LIC housing, the transmission has not
mm.
been as immediate as it would
Yeah.
have been from banks. But it's about 1 or 2 more quarters, not longer than that for
Mm.
sure.
All right, Hamsini, with that, I would, I'll let you go. Thank you for joining in
Thank you.
this morning. I know you have to go to the press conference as well, so I won't keep you waiting for long. Thank you, Hamsini.
Thank you. Thank you.
All right, then we also have a battery of experts joining in now. Joining me is Aditi Nair of ICRA. Aditi, lovely to chat with you again. What is the signal you're getting from the governor? Of course, rates have been kept steady and it was a unanimous decision. I think you guys were expecting a 25 basis point rate cut, if I'm not wrong. How disappointed are you? And do you think the fact that the CPI forecast has been cut, but growth forecast has been kept unchanged, that signals that perhaps an October rate cut could also be off the table? How are you looking at it?
So, nothing to be disappointed about. I mean, our view
Hmm.
was that either we get a final rate cut today or the extended pause starts. And I think I'm going to hold on to
Hmm.
that view. Little surprised that despite the fact that there is so much uncertainty, the growth forecast was kept unchanged at 6.5%. I think, from the time that the 6.5% forecast would have been made, quite a lot has changed in terms of India's growth dynamics. So I'm a little surprised there. We've reduced our growth forecast in two tranches to 6% from 6.5%. And it's not just about the direct impact of our tariffs on exports, but it's also what the uncertainty is going to do to private investment and private capex. There, I think we're going to end up with a delay. Whether or not a tariff deal is struck today or a month later or 2 months later, I think the basic issue is that private sector sentiment towards capex is going to be quite jittery. But this is something that I think is definitely going to be a negative as far as our growth forecasts are concerned. A little surprised by how
Hmm.
much they cut the CPI forecast. I didn't expect it to be cut this sharply. Our own view was
Hmm.
3.2% with the downside, so 3.1% is very much in line with how we're seeing things. Now, in terms of the forward-looking signal, the governor ended his speech by talking about growth inflation dynamics. If we just break it up, we know that inflation is going to fall further in the July print and probably start increasing after that as the base effect normalizes. And very much agree, we're going to cross 4% by Q4. We're going to be even higher than that in Q1. So the inflation
Hmm.
trajectory looking out is not really going to be supportive of a cut. Before the
Hmm.
October policy, we are going to have the GDP growth print for Q1. Now, I feel that the Q1 GDP growth print in FY26 is actually going to be the highest of all the 4 quarters. There's
Hmm.
been a
Hmm.
bunch of front loading, particularly government capex, and exports have also been front loaded to some extent. Both of these are only going to taper off as the year continues. So you're not going to get the bad news in the next GDP print. The bad
Hmm.
news from the GDP side is only going to come after that. So October, I really don't see how we can get a cut in October or December from the growth inflation evolving dynamics.
Hmm.
My sense is that the pause has started. The only thing that you can sort of grasp onto for a cut in October would be transmission. But
Hmm.
transmission is not bad so far. So why would that again? I don't know how we can sort of uh, take away from the data that there could be a cut in October unless things drastically change. And you know, I would imagine that the extended pause has started.
Extended pause has started. So, end of the rate cut cycle for now. Is that what you are saying, Aditi?
I think so. I don't think growth inflation will support a rate cut in October or in December when inflation rates will have risen and the 3 4
Hmm.
quarter ahead trajectory is going to look much higher than what we can see today. So that it'll be, the optics will not really support a rate cut at that point in time.
Hmm. You alluded to how, of course, the RBI has been pretty optimistic about growth, which, of course, later on will see impact from the final tariff rates. Of course, there's a lot of flip flop around that. But at ICRA, what is the forecast that you guys have for FY26 on the growth front? And looking at the first quarter of FY27 growth forecast of 6.6%, what do you make of that? Do you think that the RBI is being optimistic there as well, because it's the second half when we will start growth slowing down. As you mentioned, the first quarter growth will be the strongest, and then the bad news will start trickling in. So, what do you make of the first quarter of FY27 growth forecast that the RBI has also outlined, and your forecast as well for FY26?
For FY26 for the full year, my growth forecast is 6%. If anything, our early, our forecast for Q1 has changed quite a lot as the last
Hmm.
couple of months have brought us more data. We were at sub 6.5% until we saw the fiscal data for Q1 for the quarter as a whole for Government of India. There's been a huge increase in capital expenditure. It is on a small base, but there's also a very strong momentum that we've seen in capital expenditure in these 3 months. So it's both things. In fact, what's left to be spent in the last 9 months on a YOY basis compared to the budget estimate is showing a contraction. Okay, so that clearly tells you that you're going to have this like front loading, and then there'll be this
Hmm.
tapering off, unless, of course, any fiscal room which is there is focused towards capital expenditure, which I imagine it will be.
Hmm.
Nevertheless, I mean, certainly capex is not going to sustain the kind of growth we've seen in Q1, right? It is going to come off as the year progresses. And a similar thing for the export side, particularly for merchandise exports. So, yesterday we were tinkering around with our growth numbers. I'm actually looking at a 6.7% for Q1 because of this good
Hmm.
news that has come in the last couple of weeks. But I have a full year of six, so clearly I'm looking at sub six growth prints in some of the later quarters. And Q1 of next
Okay.
year, again, the base is a little high. I would imagine it's going to be a bit on the softer side, so possibly a little bit lower than what we heard from the MPC today.
Hmm. Okay, hold that thought, Aditi. We'll come back to you. Also joining me is Big Market Voice Sunil Subramaniam. Sunil, it is a pause, yes, but the markets were hoping for a dovish pause. Doesn't look like that, given the fact that the governor has not really tinkered with growth forecast, notwithstanding the external risks that we are facing. Uh, what is your thought? I mean, markets are disappointed. I can see that markets are in the red, of course. So Nifty is down 70 now, almost 0.3%. But how would you look at it from a market perspective?
So first of all, yes, the markets are disappointed because, like I said, 25% of the market had built in a rate cut, 50% of the
Hmm.
market had built in an accommodative stance. So from the market already relies on expectations. But if you look at, and I was in the rate cut camp, before the policy speech occurred. But hearing the policy speech, right, the first thing I have to say is that the RBI governor has to be a slave to the data. Now, you mentioned
Hmm.
that he has retained the growth guidance. He has retained. It's not that he has retained. The economic data are retaining the growth forecast. It's not the governor or the MPC committee which decides on the growth, right? They look at the data. And what the data is telling them is very, very crucial. So I think if you look at it, everybody is talking about, oh, they have downward revised the inflation forecast for the current quarter, current year. But that's not it. The rate cuts and the policy stance are for the future. And if you look at it, right, there is a U-shaped growth in the inflation. It's actually peaking to 4.9% next year. Now, what are the causes
Hmm.
for that expectation? First is that he discounts food prices because they are volatile. See, a good monsoon means good food prices is not necessarily a given. Take last year, for example. Monsoon has to fall at the right time in the right places. You don't want monsoon in the time of harvest. You want it in the time of sowing.
Hmm.
You don't want it in the cities. You want it in the villages. So just from that point of view, I think he's being very, very balanced to just say that, oh, this continuing food low prices, cannot sustain forever. And they put in a normal factor to that. And hence inflation looks at 4.9. Now at 4.9 is above their comfort zone. So how can you expect to do a rate cut? Second, what I was also a bit surprised is that the global uncertainty, he says, actually has eased. And he's
Yeah.
this tariff. See, the market is very near term in its outlook. Yesterday night, Mr. Trump's tweet is what impacts the market. But the governor has got a longer perspective. So he's looking at the fact that India has a 2% share of world exports, right? And 20% of our GDP is linked to external factors. So to that extent, right, the global uncertainty, while there's a headwind, he feels that even at a 25% tariff, which is currently on the anvil, Indian economy can survive and grow. And that's why his growth
Hmm.
forecasts are steadily above 6.5. For next year, first quarter also at 6.6. So if growth is steady at 6.5 and your inflation is rising, then there's no case for a rate cut. And one more fact, he mentioned that transmission is actually happening quite decently, 77 basis points out of a 100 basis points cut. And I suspect it's a
Hmm.
bad go through in this festive season. So I think he sees no worries about transmission. See, that was one of my main concerns before, that will the RBI governor, having front loaded the rate cuts, will he now seek
Hmm.
to do something to boost transmission? But his data is telling him that transmission is very happy. Now, what's all this summarized to? That the horse is being taken to the water, but the horse is not drinking the water. That's the Indian consumer. So the Indian consumer has got a 1 lakh crore giveaway from the tax government. They have got rate cuts coming in. EMIs have been cut. That's what he said. Weighted average interest rates have come down, and banks are chasing them, but they are still not willing to go and borrow. They are still preferring to save. So you see, banks' CASA balances are
Hmm.
rising. HDFC Bank got double digit, 16% growth in their deposits, right? They're preferring to save. SIP books are continuing to grow. So the Indian consumer's mindset, the RBI governor can't change. He's made everything
Hmm.
supportive for that, but that consumer has to go down and spend. And that's where I believe that with this season coming, I think the balance of the transmission will go through. There will be a what do you call, in Hindi word is maramari. There will be severe
Hmm.
competition at the consumer durable counters to win the
Hmm.
customer. So manufacturers plus banks and NBFCs will give a very good package of EMI to borrow and to buy things. And I think that will play through. And I think, I suspect the RBI governor thinks that, because his opening remarks were about how festival season is coming and all that.
Yeah.
So what
Hmm.
the RBI governor is saying, I've done all that I could. I see the steps happening, but final consumer is not consuming. Government is continuing to spend on capex. Services exports are growing strongly. PMI services PMI is about 60. So it's all going
Yeah.
right. So let me wait for the festive season to see if it translates. So now October 1st policy, again no change, because 23rd October is Diwali. So before that you won't really get a sense. So I think
Yeah.
the January policy, if all of these efforts fail and you still see consumer lagging, and then Mr. Trump's tariffs have come in, that's the time he will
Hmm.
do a think on the strategy. Otherwise, for me, next
Hmm.
also no rate cuts. We'll wait and observe the situation. And January, we should actually not hope for a rate cut, because I want all the RBI steps to succeed and the Indian economy
Hmm.
grow, to consumers to pick up. So I don't want to pray for any more rate cuts. I now want the economy to pick up based on all these injections. So my thing is that I think the governor has done a very good job of balancing and putting out the facts. And I think it was not a decision taken by the MPC, it was a decision taken by the data on hand.
Hmm. Sure. You alluded to the fact that, of course, the governor also started his speech by talking about the festive season. One question I was asking my colleague Hamsini as well. The cost of funds for NBFCs haven't really gone down yet. So, a move to extend EBLR to NBFCs, do you think that's the need of the hour? Because, of course, the demand for credit will also go up as festive season kickstarts this month itself. That should have happened by now, right? Or that'll the RBI should be doing that pretty soon, if not already.
But why are we depending on the RBI? See, ultimately, lending rates are market-driven force, right?
Hmm.
NBFC will want loan growth, and they will set their rates as per the market demands. So I'm not so sure that RBI has to take everything decision, changing NBFCs to bank-like structures and everything, right? I mean, it would be welcome, but I think that ultimately, if NBFCs want to win in the marketplace, they have to take their own commercial actions. And I think that this festive season will see that. See, already you're seeing in some bright spots, right? The two-wheeler sales are picking up.
Hmm.
You're seeing
Yeah.
FMCG counters saying that rural demand is picking up. There is some green shoots. So I would say that it's a bit early. let's wait for the festive season numbers to come out, because you remember one thing: there's going to be a huge amount of stocking at all the dealer points, whether they're automobiles or durables and all of that. So you're going to see the index of industrial production go up because everybody's going to stock. The point is that the stock has to ultimately go to the hand of the customer. So you see, that's the $1 million question. So I think that while RBI seeks to make a more level playing field between NBFCs and banks, and they will push towards that, it's not really the determinant factor. I think market forces ultimately will make NBFCs take the right decision. And from their cost of funds going down, see, I'll tell you what, if you look at it from a perspective of the markets, banks who are lending to NBFCs would rather lend to the customer themselves than give cheaper loans to NBFCs. So, right, when you get a rate cut option, a bank would rather go, because banks are today as big retail
Yeah,
players as NBFCs. So why
exactly.
should they go and
Hmm.
help another competitor in that, right? So to the extent,
Hmm.
NBFCs have to rely more on market borrowings rather than on loans from the banks to really get that. But second is that I think NBFCs can operate at a thinner margin than banks,
Hmm.
because they don't have that kind of
Hmm.
a huge infrastructure. They're much more digital. They're more at the counter. So I think that NBFCs will thrive without even this happening. And I'm remain hopeful that the festive season
Hmm.
should see the tipping point in the mind of the consumer. He's got tax
Hmm.
breaks in his hand. He's got EMI. He's got a festive season coming up. So I think that let's keep fingers crossed and hope that the festive
Hmm.
season tilts the balance in favor of discretionary consumption.
Hmm. Okay. That's the way. So you will you be betting on two wheelers, etc. Now ahead of the festive season? Of course, they've already started picking up traction. Sunil.
See, I'll tell you one thing, that these are all top line numbers that we talk about, right? I want to see that what level of discount are they offering? Are their going margins going to be under pressure for the volume? Now, I
Hmm.
would say yes, they should sacrifice margins to build volumes, because it will have, from a market participant perspective, it will give a boost to private capex as capacities go up. But on
Hmm.
those companies themselves, if they are going to do a loss on these fresh sales, right? Then obviously their
Hmm.
EPS numbers do not reflect that. So I would not correlate top line growth in two wheelers or consumer durables straight away going and
Hmm.
buying those stocks, because I want to see at what price they're selling it and how does it affect their EPS growth, because the market relies on EPS. But the top line
Yeah.
growth in this would help private capex pick up. I would rather go buy
Hmm.
private capex, because there the order books will go up and there's a wide range of industries which are going to benefit of that. So I will, hold my horses as far as directly these auto or consumer durable companies are concerned, and wait for the margin numbers to come out, which you'll only
Hmm.
get. Some of it will come in October, but if you see Diwali is 23rd October, so it's the January
Yeah.
result which will give you a sense of how did these companies actually do the sales. Were they like burning
Yeah.
the costs and doing it, or were they able to
Hmm.
do it on a profitable basis? Let's wait and see for that.
Okay, fair point. Aditi, I'm coming to you now. The bond markets were pricing in at least 60% participants were pricing in a rate cut in September. Do you think the bond markets are disappointed? A, and secondly, uh, 10-year yields had risen somewhere around 10 to 12 basis points since the last policy. Uh, now with the RBI maintaining status quo, would you expect this to anchor short end rates, and could that lead to a flattening of the yield curve, so to say?
I think only minorly. My sense is that most of the bond market was probably expecting a pause today and a cut only maybe down the line.
Hmm.
And With the pause today, I don't think that there's going to be too much that is going to change. In any case, the hope of a last rate cut only if the market becomes convinced that it's imminent. Do I expect that the rates will come down? For the time being, I think we'll be plus minus 5 basis points of where we were yesterday.
Hmm. Okay. And what about liquidity? The system liquidity right now, as per the governor, is 3 lakh crores. With rate transmission broad based, do you think the RBI will maintain these levels, or they would look at reducing it a bit here on? What's your sense?
My sense is that it's actually gone up a little bit in the last couple of weeks, probably because of
Hmm.
government spending, and some of that frictional stuff will keep happening. Right now, of course, we're in the middle of the monsoon. We have a couple of months more of the monsoon ahead of us, and again, capex picks up in volume terms after that. And next month we'll be back in the phase where the advance tax, etc., money is coming in. So a lot of the frictional factors will continue, and CRR cut will come in Q3 as well. So let's see, what level of liquidity the RBI is going to be comfortable with maintaining in the interim.
Hmm. Okay. Aditya, I also have another question that's on inflation because, sometime next year we have a new inflation series also that will come in. Is it really possible to actually, forecast inflation for the longer term reasonably now? Because food weightage, of course, will go down by a few percentage points. So, how do you really assess long-term inflation over the next 9 to 12 months, so to say, once it kicks in?
No, that's not long term. That's medium, not even medium term. I thought long term you mean like the next 5 to 10 years, which is like the kind of crystal ball gazing economists are asked to do. So,
Hmm.
again, I'll start with the crystal ball gazing first because that's probably the easiest to address. I think with the way that Indian demographics are expected to keep domestic growth and particularly for consumption on the higher side, possibly broadly we need to be able to live with an inflation of between 4 and 4.5% over the medium to long term for next year. So basically, your question is FY27, where do we see growth, right? On
Yeah.
the
Hmm.
current
Inflation. Hmm.
CPI index, I would expect CPI inflation to be around maybe 4.5% next year on the current index. Now, how the
Hmm.
new indexes weightages are different, the dynamics are a little different. It could be a little bit higher or lower than that. Right now, we're in a phase where food inflation is very low, and food inflation is the biggest determinant. If in the new index, food inflation is food items are going to have a slightly smaller weight, but inflation is going to normalize and come back to the 4 to 5% kind of mark, then maybe it'll sort of offset each other. 4.5%, I think, is probably a reasonable assumption for FY27 on a
Okay.
low
Four
base
and a
of
half. Hmm.
3.2% this year.
4.5. Yeah. Sunil, coming to you, let's also talk Fed because the data coming out of the US has clearly indicated that the job market is slowing down. Consumers are also feeling the pinch, and the case is building of a September rate cut from the Fed. Uh, do you see that scenario taking place? And would you see another two, or would you envisage two rate cuts from the Fed this year, or would that be a little, too much?
So two things there. Yeah, let me lead with saying that I do expect two rate cuts, but the reasons are not what you pointed out. You're
Hmm.
talking about the labor market and all of that. See, those are all data driven facts. You can't predict how the labor
Hmm.
market will grow, what is the impact of the tariffs and coming through, and what is the impact on inflation of the tariffs. Because by and large, from the earlier fears, the tariffs have now on an average are settled at about 20 odd percent if you take the US basket, right? So I think that that's not a big impact because of the 20 odd percent, the way I saw the breakup, 40% was being picked up by the American companies, 40% by the American consumer, and 20% by the exporting country companies, right? So our 20% increase in tariff translates then to an 8% increase in retail prices. So that's not really the a great inflation trigger. So my
Hmm.
point is very simple that whatever the data comes, Fed has to respond to that. But I believe that two rate will happen because of Mr. Trump, because of the intense pressure he's putting, right? And he's got one person to resign. He's going to put two people, new, his favorite people into that. And then
Hmm.
he's going to, Trump, and Powell has got what, 8 months or less to go, right? So I think he's
Yeah.
just going to, he's such a personality, a forceful personality with getting his way. Is that he will reject this whole board? There were rumors that he had asked Mr. Scott Bessent, who's the Treasury Secretary,
Hmm.
to go, but he's declined. But I'm just saying is that that sheer pressure of that, right, will make that happen, I suspect. And the second thing that Trump is doing quietly, I heard, is that he is changing all the maturities which are coming up. He's asking the Treasury team to borrow only 1 year, clearly saying that don't go and re-borrow for a 10-year period, borrow 1 year, because definitely within the next 1 year interest will drop and you can price it back. So I think the amount of
Hmm.
intense pressure between the politics and economy. See, luckily in India, we have a talmail between the RBI governor and the fiscal policy. They both are thinking and acting together. Sadly, that's not the case. But if you ask me who will win, it is Mr. Trump who will win in his own way, brutal, ruthless, but he will have his way. So I believe that those two rate cuts will happen because it's going to put such immense pressure on the system in some way. So they have this Sanskrit saying, them done the way, whatever. He will use every tool in his power. So it's in that sense, then I would say a bet on a rate cut. And incidentally, that will also weigh on RBI, because
Exactly,
rate
which is
cut
why I was
between the
whether
country, right? So
one in December. Yeah.
So I think that that rate cut means what? The differential between the US interest rates and yes, it's around roughly 2%, right? So if it
Hmm.
does a rate cut, right, that means that differential widens. And that
Yeah.
means if the differential widens, then rupee has to weaken.
Hmm.
Now, that if you look at it purely, then the RER, real effective exchange rate, will go out of whack. Now, at that stage, of course, it also depends on whether the governor feels that we need to support exports, right? In terms of that, because exports benefit from a devaluing rupee. So one way for him is say, I don't do a rate cut, that the differential widens, which means automatically there's a depreciationary pressure on the rupee, which would help our exports, right? Is one because
Hmm.
the current account you are saying the CAD is very good. Remittances are growing very strongly, and services exports are growing very strongly. So there's no cause for concern on the balance of payments or the credit, the CAD. So from that point of view, a rate cut from the US, right, would mean, and if he doesn't do a rate cut, would mean a gently depreciating rupee, right?
Okay, I think
Because
we lost Sunil. Sunil,
hello,
I
can
think
you?
there's some issue with your internet connection. I think we should just fix it
Suddenly,
because I think the most important part that you came when you came to the most important part, your line snapped all of a sudden.
can you hear me now?
Yeah, I can hear you.
So what I was saying was that, so if the differential is roughly 2% today,
Hmm.
so if the Fed
Hmm.
does a rate cut, right, they are at the lower than us as an interest rate. So the thing widens. So when it
Yeah.
widens, there is pressure on the rupee to depreciate,
Hmm.
right? Now there's enough reserves at the RBI's hand with $688 billion and remittances and services exports growing well to compensate for that flow, right? And keep the rupee stable. But if he feels
Hmm.
the pressure there, then he might want to act because if imports are going to come and rise, then he'll need to feel the pressure. So he may then his hand may be tilted in favor of a rate cut to maintain
Hmm.
parity with the US. That's the only
Hmm.
thing that to look forward to for a rate cut in October. If at all
Yeah.
Fed suddenly does a
If at all.
dramatic, 50 basis points rate cut in September itself. I'm not
Hmm.
saying
Hmm.
probability is very
Of
low,
course,
but that could tilt the
hypothetically.
governor's hand because they also have a
Hmm.
job of maintaining the currency at a
Yeah.
effective exchange rate, which is neither favoring imports nor favoring exports. So it's an
Hmm.
interesting dynamic. And jobs data next, all the next print will come and say NFP rose, and then everybody will see how much will get that. So rather than look at that data
Yeah.
because you're not in control of it, right? I
Hmm.
think the right way to look at it is that I would say between politics and economics, there the politicians will win.
Hmm.
So I would
Sure,
be
got
on that
it.
cap.
Aditi, where are you on the rupee trajectory? Would you concur with Sunil that RBI has maybe forced, if at all, once in fact the Fed doles out a 50 basis point rate cut, not at one go, perhaps he may do it in two meetings, but once that happens, then then do you see a case for a rate cut, Aditi? I think we have lost Aditi there.
Hmm.
So okay, so then okay, fine. Sunil, let me ask you one thing about the market. We've been around that 24,600 mark. We've defended that. We've fallen below that, etc. But the markets are really waiting for one positive trigger, which is not really coming by. One would have hoped for a 25 basis point rate cut. Perhaps that would have given some bit of fillip to the bulls, but that hasn't come by, and the chances of another rate cut in October have dimmed, so to say. And of course, there's this big threat looming from Trump. Next 24 hours, higher tariffs on India. How does one navigate? Because that push is not coming through. Do you see more correction? Perhaps once those 24 hours are over, or would you say that taco trade is very much on?
No, I wouldn't call it taco trade, but I think what's happening in our market, you realize that is entirely the DI action which is driving the market. FIs right from the beginning of July have been continuously selling. DIs have absorbed everything that they have thrown at them and kept the markets, but the DIs have been very choosy. right? They have not bought everything the FIs have sold, right? They have been very, very sector specific, right? So IT has suffered, pharma has suffered,
Mm.
right? So they have been very carefully choosing what they buy, right? So why I'm saying this is that now with this whole last 24 hours tariff related, one thing is that I think a lot of that bad news is in the price of those sectors.
Hmm.
So whether it's all the export oriented sectors have been pretty much hammered, and I don't think
Yeah.
there's so much more room to fall, because as it is there was not much buying support there, and that's why the
Hmm.
falls happened. So from that point of view, I would say that DIIs are constantly looking at two things, right? One is where is their growth as the earning season pans out. We are still probably coming to the end of it, but guidances and all are still coming through. So they will be careful about where is the domestic growth which justifies the higher valuations. Because one thing, remember, Indian market, despite all of this, Hamara Rona Dhona, is still not cheap, either from a
Hmm.
long-term average or from related to emerging market. We are not cheap. Why? Because our growth hasn't piped up to the extent expected. One, and two, because DIS have been consistently buying 65,000 crores of buying every month from May, June, July. So 2 lakh crores they have bought. So they're not allowed the market to fall. So where I'm coming from is that so DIS now, within the current valuation situation, will look for a growth opportunity within the domestic oriented sector, because there's no way they
Hmm.
can take any call on an external oriented sector because of the uncertainty prevailing.
Yeah.
So they are
Hmm.
going to focus their energies around where they see pockets of future growth coming in from the guidance. And it's not necessarily that company's guidance, it's that company's guidance. Like I'll give you two examples. Bajaj Finance said something about the MSME business. So the impact
Yeah.
was on the MSME. Similarly, L&T said something about capital goods. There's been a positive impact on the capital goods. So it's the earnings which they form their blue sky picture of India, non-export, non-related. They will buy that.
Hmm.
The second is because of these corrections happening in the external sectors, they would be stepping in to do value buying, saying, "Iske aage or how kharab can it be?" So we are close to the bottom in the correction, so I'll buy. So I expect a
Hmm.
consolidating market. I don't expect a market to crash or whatever,
Hmm.
because domestic fund managers have liquidity. And when they get money from in another few days, you'll get the monthly flows numbers, and I'm sure the SIP book would have been even higher. The domestic investor
Hmm.
continues to give money to mutual funds, so they cannot keep piling up cash. So they'll keep buying. One of these two filters they will keep. Has this corrected too much, or has this growth now looking better? They'll keep buying.
Hmm.
So overall in a market, you will see there will be a lot of sector rotation, but the market as a whole will be in a consolidating sideways movement pattern, right? And
Hmm.
any simple good news which comes from some Trump saying, okay, like he's already said something like, I never said a percentage penalty. So,
Yeah.
so it's an unpredictable person. So who knows? Suddenly tomorrow says, Mr. Modi is my friend, so I will do this thing with him. We don't know. So anything that the FIR return will take the market to new highs. But in the
Hmm.
absence of that, I don't expect a steep correction overall in the market. There could be some corrections in the external sectors as some bad news comes. There's pharma. What he said about pharma saying I'm going to go
Yeah.
to 250% tariff is very scary. So sector specific, obviously, I would not ask anybody to take a call. Stick to domestic oriented sectors from that. But do not think that the market is going to correct further and I can come then and buy. If you're a medium term
Hmm.
investor, right, stay diversified. Let the fund managers pick the sectoral calls. This is not a time for you to go and bet on a sector, unless, of course, a domestic oriented sector, there is a relative safety there. But you might miss out on the growth which will come from the bounce back in the external sector. So I would say stick to diversified mutual funds as your play, right? And I would identify two particular type of funds here: multi-cap
Hmm.
funds and multi-asset allocation funds. The reason for
Hmm.
that is that multi-asset allocation have gold and silver. See, all this uncertainty is still leading to a positive there, and a rate cut in the US means that
Hmm.
dollar weakening is positive for gold and
Yeah.
silver, right?
Yeah.
So I
Hmm.
would say you have to keep that amount of gold and silver in your portfolio. A multi-asset allocation is best, and in these multi-asset allocation funds, they have a large cap tilt in the equity side. Okay, so you would get a mix of commodity debt and your large cap equities there, and then you choose a multi cap fund as your contra there. I mean, as your additional fund, because there you make
Hmm.
sure you're getting in your small caps, your mid caps, and most fund managers have to keep 50% at least in mid and small caps there. So you'll get a nicely balanced portfolio across the cap curve, across commodities and and fixed income. So I would say in this uncertain time, these two are the ideal products to complement in your boutique, and keep it there at this point until we get a very clear clarity post the festive season, which will probably be really known in the results of the January first week, October, November, December quarter that comes through. So you're going to be for a prolonged period. You're dealing with headline news, and somebody saying, "Oh, two-wheeler sales went up, this went up, that went up."
Yeah.
So you're going to be clutching at those straws to know what the EPS growths are going to be, because ultimately market is dependent on strong future EPS growth. That's what we want.
So yes, so before you bet on the festive plays, wait for the margin picture to emerge, how the EPS picture looks like, and then take a call. That's the view. Last question really, Sunil. We have the press conference at 12 p.m. From the governor. Anything in particular that you'll be watching out for in the post-policy press conference?
I think that there was no surprises on which the RBI government will be probed. He will be repeatedly asked whether you mean the future rate cut, and he will again say it's a data dependent answer. So I think that there might be some of the press who would ask them more about the micro details in terms of regulations easing up. What you said about NBFCs moving to the bank type of lending basis and all of that. There will probably be questions around that, and he may clarify. But to me, going by the previous two times that he did the press conferences, I don't think he really gave away anything new at the press conference, which he had not broadly covered in his speech. And the copy of the speech would have been given to the press. So I'm not really expecting any undue surprises from the press conference.
Okay, not expecting any undue surprises from the press conference. With that, I'd like to thank you, Sunil, for taking our time and joining in. Appreciate your joining in and putting things into perspective so simply for us. And I look forward to more conversations in the future as well. Of course, after the big promise that Trump has made that he will slap a higher tariff on us, once that also happens, when there's some clarity on that, of course, we'll touch base with you that time as well. Thank you. Well, with that, of course, we've come to the end of this special coverage on the RBI policy. It is a pause, not a dovish one at that. That's what experts say. It could be the start of a prolonged pause, and perhaps we may not see a rate cut in October or December. But, only time will tell. But that's the news from the RBI, and the markets have reacted negatively because they were hoping for a dovish pause or a rate cut. Neither of them have come by. So the Nifty is down below that 24,600 mark as of now. All around weakness. But of course, the big threat from Trump is looming. So perhaps the focus is also more on what he does next. But with that, thank you for tuning into Money Control. Stay tuned to Money Control for all your other news and updates. And have a good day. Thanks for joining in.